As a young man, heard the sky's the limit. First thing first, I'ma break through the ceiling. One life jam, but it feels infinite. One life damn, then I better go get it.
This podcast is being brought to you by the Reyes Group at IA Private Wealth. That is made up of myself, John Reyes, a wealth advisor, and Gillian Seguin, an associate wealth advisor.
Well, hello there. I am Gillian Seguin, associate wealth advisor at Reyes Group at IA Private Wealth, and I am so excited and so pleased to introduce you to my guest. I know our BEARable conversation today looks a little different. It's just going to be me today. And with me today, I have BeiChen Lin. He is the Senior Investment Strategy and Head of Canadian Strategy at Russell Investments, all the way here from Seattle today, but on a road show to Vancouver and Edmonton and all over the place, and speaking with affiliates in Asia. He hasn't slept in several days, but he's made time for us, so thank you so much.
Happy to be here. I'm always happy to be here and to help our clients understand how to navigate this really challenging and unprecedented time that we find ourselves in. So don't worry at all about the lack of sleep. You know, I'm sort of used to it, but at this point in time, I would say.
There we go. If you can get in a rhythm or a momentum, then just takes over, right? Adrenaline kicks in.
The only thing is the mattress companies are probably a little bit upset with me at this point in time.
All right, so take note. Don't invest in sleep country right now. But you are with Russell Investments, and I was just looking at your biography, which is very extensive and very impressive. And ultimately, what you're doing there is analyzing the markets on a macro level, providing commentary, and also you are making investment recommendations for their portfolios. Is there any particular mandate or portfolio that you oversee independently, or are you just kind of providing commentary to all of the managers at Russell's?
Sure. So our team, the investment strategy team, is pretty broad scope in mandate. We are a global team, and our job is threefold. Number one is we're trying to build models that can help us better understand what's going on in the markets, what's going on with the macroeconomic situation. Number two, we want to provide recommendations to our internal portfolio managers, help them understand when should they be thinking about adding risk or reducing risk. And number three, we want to try to help our clients, whether it's the institutional clients that we have or the retail clients that we have, understand how to effectively navigate the market volatility.
Yes, and I would think, like many people right now, they are being very short-sighted in sort of what information they're trying to get from you, how to react today with the way the markets have been. And I would hope that what's going to come out of this is more of a macro, as we say, macro outlook, and looking at the bigger picture and planning for a more longer-term strategy, would you say?
I think it's definitely important to have that type of long-term orientation. One of the words that I've been hearing a lot recently on the road is that people talk about how unprecedented of a situation this is and how it's tough to be able to handle the unprecedented. But even though this might be a situation we haven't seen before, if we think about it, I mean, in our daily lives, we're often faced with new situations. If you think back to, for example, when people were in school, when they were in university, how many professors do you know who would give a midterm question that's straight from the textbook? Very few, right? There's a lot of professors who like putting challenging questions in there. But students can still do well in those challenging exams. And the reason for that is because you'll see some students, they've studied hard, they've built up a framework, they've built up a disciplined approach to say, these are the principles I know, these are the principles I follow, and this is how I will handle that challenging environment. And I think it's a similar thing when it comes to the world of investing, that yes, we might get thrown with a new situation, a new topic, a new trend, but at the end of the day, as long as we have our guiding principles, I think that's the key thing.
Right, stay the course, build a strategy and stay the course, which is really what we tell our clients a lot of the time. I think let's jump into it. Market outlooks, when we look at Q1, very interesting. When I looked at sort of when I analyzed what happened, we saw a lot of the global equities actually holding steady and in the positive territory, and a lot of the negativity was really just isolated and quite self-inflicted to the US, driven by sentiment and consumer confidence. What do you see happen in Q1 and in the markets on a whole, and where do you see we're going here?
So I think I'll break up Q1 into two components, sort of before the tariff situation and after the tariff situation. So coming into the tariff situation, what we saw was that a lot of the equities outside of the U.S. were actually doing somewhat better than equities inside the U.S. And we saw, for example, even within U.S. stocks, we saw the S&P 493 outperform the Mag 7. And I think part of the reason for this is really that starting point of valuations, right? So if you think about what happened in 2024, the dominant story in the US was Mag 7 because there was all this excitement around artificial intelligence. But that led to a situation where you saw a widening of the gap in valuations between S&P 493 versus the Mag 7. And into a market where you saw broadening earnings growth, I think it was reasonable to see a closing of the gap where you saw the 493 started to catch up to the Mag 7. Mm-hmm. And then if we think about the dynamic of Europe versus, for example, US, in 2024, Europe was under pressure. We know parts of Europe even entered a technical recession in 2024. But in 2025, we were starting to see some positive green shoots emerge. So for example, if you look at credit activity in Europe, a lot of the companies depend on bank financing. They depend on bank loans to be able to finance their operations. It's not like in the US where it feels like we have tons of private credit firms. Mm-hmm. And so it's encouraging to see bank lending activity pick up because it means that more businesses are probably thinking about expanding their operations. And so with the European economy being on firmer footing compared to last year, and with European equities trading at a valuation discount compared to US equities, I think that was another reason why we saw Europe initially do better than the US. Now, of course, once the tariff announcements came out, then it was a little bit of a shift in the situation where we started to see the tariffs really weigh on equities not only in the US, but also globally as well. Because I think for investors, one of the key challenges is that uncertainty, right? It's not just what is the tariff rate today, but it's what is that tariff rate going to look like 5, 10, 20 years down the road from now?
Yes, yeah, and I just want to sort of clarify or explain for our viewers when you talk about the Mag 7, you're talking about those FANG stocks, well, now referred to, I heard, as Batman. Have you heard that?
We're going to get a new acronym
Have you
every
heard
single
that?
month.
I love
get a
that.
New acronym every single month.
love that. Batman sneaks up on you at night.
There has to be, in my mind, there has to be a contest for who can come up with the best acronym.
Well, do you have any in your back pocket that you want to throw out?
Not yet.
Not yet. Okay, we'll work on that for next time, okay? So that was really helpful for us to understand, and I wonder how much the inflationary environment and the dropping of interest rates impacted also when you're talking about people sourcing out credit now and looking for that expansion. Do you think that had any influence on that?
Yeah, so we saw global central banks cut interest rates, whether it was the European Central Bank, the Federal Reserve, whether it was the Bank of Canada. These major central banks across the world started cutting their interest rates in 2024, and you're right that as interest rates come down, people are usually going to be more willing to borrow money.
Yeah, well then we had that consumer confidence. People would borrow money, but they were thinking, I'm not going to push it out or allocate it, or, I'm not going to spend it because who knows in this uncertain market what's going to happen.
I think you bring up a really good point about consumer confidence, and I think it's one of those examples of the divergences between what we call the hard data and the soft data.
Yeah.
So if you look at the hard data, whether it's initial jobless claims in the U.S., we're tracking less than 260,000 jobless claims a week. That's a pretty low level of jobless claims. If you look at the Q4 earnings season, S&P 500 companies generated earnings growth of 17% year over year. To put that number into context, the longer term trend is usually 8% year over year earnings growth. So 17%, you're talking about double that longer term trend. And then if you look at the interest rate environment, as we were alluding to earlier, interest rates are now gradually on their path down. So we're seeing a more normalized rate environment. So fundamentally, there's a lot of signs of resilience in the U.S. economy,
yes.
But it is the soft data that's pointing to signs that people are starting to get a little bit more anxious about what's going on. So, for example, if we look at the number of times that people have been searching the word recession on Google,
yes.
We've seen a sharp increase in that statistic right after some of these tariff announcements. If we look at, for example, the University of Michigan Consumer Sentiment Survey, we did see a sharp decline in consumer sentiment. Now, we know that sentiment survey is highly linked to inflation, and every time you talk about tariffs, people do get a little bit more worried about inflation risk. And I do want to clarify, though, that when it comes to tariffs, and I think this is a really important point, tariffs, generally speaking, represent a one-time boost to price levels, whereas inflation is more so about a rate of change. So the actual inflationary impulse from the tariffs, it will usually moderate over time unless we get repeated escalation after escalation. And then the other sentiment measure that I've been keeping a close eye on is really the NFIB survey. So this is an index of small business confidence in the US. And what we saw initially in late 2024 was post the election, there was a massive bump up in small business confidence. But now that we've had these tariffs start to get underway, we actually saw a reversal and we've lost about half of that post-election bump in confidence. So the hard data is telling us one story, the soft data is pointing to more signs of anxiety, and really the question for us going forward is, how do you reconcile the two, right? Do we have a world where people start cutting back on their spending because they're getting more worried? Or conversely, do we have a situation in which, because spending is still robust, capital expenditures is still robust, people end up feeling better about the economy? And so that's really something that's critical to watch.
So I wanted to then, just to follow up on that, is in Q1 we had Doge take a chainsaw to employment in the US. We had hundreds of workers in Canada get laid off, particularly in the aluminum and steel sectors. Those numbers, those technicals or those hard data are not going to start to really materialize until Q2. Would you agree with that? And how does that, we are also seeing inflation starting to tick up a little bit. So how do you see that impacting, the overall market in Q2?
So I'm glad you asked about Canada, and as you know, I'm Canadian. I'm very proud to be Canadian. But when you look at the Canadian economy, it's not nearly been as resilient as the US economy has been, and it's particularly noticeable in, for example, the labor market. So in the US, the unemployment rate is still relatively close to that historical low. Yes, it's moved up off of its trough, but it's still relatively low in the historical context. In Canada, the Canadian unemployment rate right now stands at around 6.7%. So it's more than 1.5 percentage points above its 2023 low. And we look at the most recent jobs report, the Canadian economy actually lost 33,000 jobs in the month of March, whereas economists were forecasting a small gain of about 10,000 jobs. So the Canadian economy has been under more pressure from the labor market front, but also from a growth perspective as well. GDP growth, even though on a headline basis it's been robust, but you got to remember that Canada has seen a pretty elevated rate of population growth as well. And when you adjust the GDP numbers to reflect the population growth, what you saw was that for many quarters, we actually had declining GDP per capita. And then in the most recent Q4 data, we actually had flattening GDP per capita. So the Canadian economy is starting off from more fragile footing. And that's one of the things the reasons why I think that going forward, the risks of an economic slowdown might be a little bit more elevated in Canada than in the US. So in the US, it's probably close to a coin toss in terms of the recession risk outlook over the next 12 months. In Canada, my number would be about 65%.
I have so many questions I want to ask you. This could go on for hours, but I'm going to try and be cognizant of your time and also of all the information you have, try to hit on as many points. So we've talked a lot about the economy. We talked probably a lot about the markets in general. Let's talk asset allocation. Let's talk fixed income. In COVID, we saw all of the asset classes kind of have a direct correlation almost. Everything was kind of dropping off. We saw equities dropping off. We saw bonds dropping off. And inflation was eroding the value of your dollar. So even if you sold everything, put it under your mattress, you were still going to take a hit. We started to see more of a divergence. How do you see that going, where fixed income is becoming sort of a risk-off asset, and equities are going back into that? We should have that 40-60 split or whatever the asset allocation model is for that particular client. How do you see that going, and what can you comment on that?
So when I was taking statistics classes, one of my professor's favorite word was time varying. And I think the word time varying is a great word when it applies to correlations, because the correlations between asset classes does change over time. So if you look at, for example, 2022 was a year in which both equities and fixed income tended to have declines in their asset classes. But then more recently, we've been seeing fixed income play more of a role as a traditional portfolio diversifier. And so I think when it comes to looking at the correlation between asset classes, it is really important to have that more longer term perspective as well. So generally speaking, how we think about asset allocation at Russell Investments is we start with what we call the strategic asset allocation. So we have an asset allocation team that puts together capital market assumptions about how correlations might behave over the next 10 years, 20 years, and further. And this is our starting point. And our philosophy is that most of the time, we think that investors would benefit by staying disciplined and sticking to that long-term plan. But there are going to be those occasional instances where the markets get so dislocated, so one-sided, that it can potentially create an opportunity for a tactical move in the portfolio. But in order for us to make a tactical move in the portfolio, whether it's to overweight or to underweight, we really want to see a high bar, a high threshold being met before we are able to make that decision. And so at Russell Investments, we have what we call a cycle, valuation, and sentiment framework. So we use all three of these factors in conjunction to ultimately determine whether there is a dislocation that's significant enough in any particular asset class, and that's how we decide whether to overweight or underweight from a tactical perspective.
Yeah, I think tacticals, so many people in markets like this have that FOMO feeling, right? Like, I didn't pull the trigger. Should I go in? It started to climb. Is this the bottom? And that tactical approach really removes that and just goes when the indicators are telling you to go, and pull out or sell when that's what the technicals are telling you.
So that's also the other challenge, right? Is so we employ both a quantitative and qualitative approach at Russell Investments, because ultimately, even though a lot of these quant models are great, we think it's also important to overlay that with our experience, the power of our global teams that we've built up over the years as well. So maybe to give you an example, one of the things we've seen recently as we're filming here in mid-April is we saw that our measure of investor equity sentiment, that sentiment measure as of April the 8th reached a 98th or 99th percentile extreme, which means markets have become so panicked that they were more panicked than in 98 or 99% of the time throughout history. And generally speaking, when we look at historical experiences where you did see the markets become so oversold, so panicked, the future returns on stocks generally tends to be quite attractive. But the reason why we didn't go tactically overweight equities, even when we were seeing significant signs of market panic, is because we layered on what we were seeing on the cycle side of things, where our estimate of recession risk for both the US and Canada was higher than normal. The average risk of recession in the US is about 15 to 20%. So if we had an estimate of 50% for recession risk over the next 12 months, it's higher than average. And so when you balance those factors out, we decided that, yes, there were some encouraging tailwinds in terms of perhaps the market might have overreacted, but at this point in time, we just didn't see enough of a premium to justify
going all in.
But at the same time, we decided that we did not want to underweight risk assets. We don't want to go to cash, because when others are panicked, this is the time for us to really stay disciplined and stay in.
Yeah, we talked about that, right? When others are panicked and running out, you have to have a bit of a contrarian approach to seize on these opportunities. And that's a lot of what we've been doing is, let's do something, but let's not go all in here, because I mean, as we saw yesterday afternoon, if Trump removes the tariffs completely, or we are, beyond just delaying them, we get some certainty, this market will whipsaw back up, and you'll feel good you did something when everybody was running for the gates. Inversely, if you do a little bit now and the markets go lower because in Q2 that recession fear elevates, then you can buy more. So yeah, I like that approach of just like, let's take some opportunity here, but this is not calling the bottom by any means, right? I guess I'm looking at some points that I had written down. We've talked a lot on tariffs. I want to maybe just close out, if you can give a little bit more information or a little bit more commentary on the dynamic between US and China, and where you see that going, because that's really, as of today, where the war is materializing just between the two countries. And hopefully, or what the markets are hoping, I think, is that the allies of the US start to kind of come in line with the US to some degree, and they have more of a united front, I guess, against China. What do you see, how long do you see this lasting? And how do you think China's going to ever, if they are going to negotiate, or if they're not? Yeah, I'll stop there. I'm talking a lot, but.
So lots of moving pieces there to think about. In terms of what we're seeing between China and the US, these two countries are just so incredibly intertwined from an economic perspective that I do think it is in the best interest of both countries to be able to ultimately reach some sort of agreement, some sort of a deal. Where I think the challenge is in both countries, whether it's the US or China, you have government officials who need to be seen as being tough on the other side. And that can sometimes make it more difficult for the parties to come together and reach an agreement. But again, I do think that it is beneficial for the parties to be able to reach an agreement. And I'm cautiously optimistic that the business leaders in both of those respective countries can help encourage their local officials to ultimately come to the bargaining table and to be able to reach some sort of deal between these two parties. But in terms of the competition and the rivalry between the US and China, I think both countries want to be seen as the more innovative of the countries. Both countries want to be seen as the one that can develop the most groundbreaking technologies. And so I think that longer-term rivalry between China and the US, even if we do get an agreement on trade where these reciprocal tariffs come off, I do think that rivalry between the two countries is likely to persist for some time. But that also creates some opportunity, in my mind, for some of those smaller countries that are able to effectively partner with both, not just one of the two countries. So more specifically, if I look out over a 10, 20, 30-year horizon, I'm thinking about some of the ASEAN countries, the smaller countries in Southeastern Asia, like the Philippines or Vietnam or in Indonesia, the countries that are able to maintain effective relationships with both sides of this rivalry. I think there could be some interesting opportunities there from the long-term perspective.
Yeah, I hope something good comes out of all of this for sure. And I said that was the last thing, but I do want to ask you just on the dollar, the Canadian dollar. It's starting to climb a little bit here. Where do you see that going?
So from a near-term perspective, the Canadian dollar's trajectory is a little bit less certain. And I think really that depends on whether or not the economy falls into recession. Generally speaking, what you usually see is that if the economy falls into recession, the US dollar would strengthen, and that would cause some further weakening of the Canadian dollar. This time around, we're seeing a bit of a different dynamic where initially, when the tariffs first came on, we did see the US dollar strengthen against many major currencies, including the CAD. But then subsequent to that, we actually saw the US dollar give back some of its strength. And I think this is partly because if you look at, for example, purchasing power parity model evaluation, it would suggest that the US dollar is somewhat overvalued on a medium-term basis against major currency pairs, whether it's the CAD or the euro or the Swiss franc, et cetera. And so from a medium-term perspective, I do think there's more room and scope for the US dollar to weaken, and that should benefit the Canadian dollar. But from a more near-term perspective, it can be a little bit more challenging to forecast.
For sure. Okay, well, I can't thank you enough. I hope you've enjoyed your time with me here. I haven't been too wordy or too imposing on your vast knowledge, and I really appreciate you coming to see us today.
This was fantastic. Thank you so much for inviting me.
Okay, thank you for listening, and we'll see you at the next podcast.
As a young man, heard the sky's the limit. First thing first, I'ma break through the ceiling. One life jam, but it feels infinite. One life jam, then I better.
This information has been prepared by John Reyes, Wealth Advisor, and Gillian Seguin, Associate Wealth Advisor for IA Private Wealth Incorporated, and does not necessarily reflect the opinion of IA Private Wealth. The information contained in this video comes from sources we believe reliable, but we cannot guarantee its accuracy or reliability. The opinions expressed are based on an analysis and interpretation dating from the date of publication and are subject to change without notice. Furthermore, they do not constitute an offer or solicitation to buy or sell any of the securities mentioned. The information contained herein may not apply to all types of investors. The wealth advisors can open accounts only in the provinces in which they are registered. IA Private Wealth Incorporated is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Incorporated operates.